In which year start from January to December is called calendar year. Which year start from April to March is called financial. 4,000, 1 by 4 is 1,000, 4,000, 3 by 4 is 3,000, 2,000, 1 by 4 is 500, 3 by 4 is 1,500. Here, auditor fees is not mentioned as combined. Auditor fees is not mentioned. So, as a student, you consider as an internal audit, go with the time ratio. Hello, my dear student. I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. Today, in this session, I am going to hand Corporate Accounting 1, third semester Unit 2, Session 2, in favor of profit prior to incorporation. In the last session, we already solved one problem regarding this profit prior to incorporation, pre-incorporation and post-incorporation. I already explained what you mean by pre-incorporation and post-incorporation. Any profit earned before acquisition, before incorporation, from the starting date to incorporation, it's called pre-incorporation period. From incorporation period to year ending is called post-incorporation period. I will repeat. There are two, pre-incorporation and post-incorporation. Whatever the profit earned before incorporation is called pre-incorporation profit. Whatever the profit earned after incorporation is called post-incorporation profit. From the starting point to incorporation stage, that is registration stage, it's pre-incorporation period. From pre-incorporation to year ending is called post-incorporation stage. Whatever the profit earned this year, pre-incorporation profit is a capital profit, post-incorporation profit is a revenue profit. We'll move on to problem now. X Company Limited was incorporated on 1/7/2019 to take over the business of the A and B with effect from 1/4/2019. So the previous company starting period is 1/4/2009. Takeover on which date? 1/7/2019. Sales for the year ending 31/3/2020, rupees 5 lakh, divided into 1 lakh sale up to 1/7/2019 and rupees 4 lakh for the remaining period. Gross profit for the year is 1,25,000. The expenses for the year, all these expenses, calculate the pre-incorporation and post-incorporation profit for the year ending 31/3/2020. Now, I am going to explain. Pre-incorporation from starting period 1/4/2019 to, that is 1/4/2019 to 1/7/2019. See the date? Pre-incorporation period, starting date 1/4/2009. So 1/4/2019 to 1/4/2019 to 31/3/2020 is 1 year. Financially, we say there are 2 years. One is called calendar year, start with January, end with December. Another is called financial year, start with April, end with March. I will repeat. In which year start from January to December is called calendar year. Which year start from April to March is called financial. What is the starting day? 1/4/2009. Year ends on 31/3/2020. A company, AB company was taken over, which was started on 1/4/2009 and take over on incorporated on 1/7/2019. So April, May, June. July takes over. How many months? 3 months. From 1/7/2019 to 31/3/2020 post incorporation which date 1/7 to 31/3, 7, 8, 9, 10, 11, 12, 1, 2, 3, 9 months. So pre-incorporation period is 3 months, post-incorporation is 9 months. Therefore, time ratio three is to 9, that is 1:3. So pre-incorporation period from 1/4/2019 to 1/7 3 months, post-incorporation from 1/7/2000 to the year ending 9 months. So they are in the ratio of 3 is to 9, 1:3. Now, sales ratio. See that. Sales for the year ending is 5 lakh divided to 1 lakh up to 1/7/2009 and 5 lakh remaining period. So pre-incorporation is to post-incorporation. So pre-incorporation sales 1 lakh, post-incorporation is 4 lakh. We cancel the zeros, they are in the ratio of 1:4. This is sales ratio. So two ratios are necessary. We require one time ratio, one sales ratio. Time ratio based on the number of months, whereas the sales ratio based on the sale. Now we are going to divide one by one. Salaries 24,000. Gross profit for the year is 1,25,000. Gross profit 1,25,000. Pre-incorporation 1/5 into 1,25,000. 5 2s are 25,000. Post-incorporation 4/5 into 1,25,000. It is 1 lakh. So 1/5 of 1,25,000 is 25,000. 4/5 of 1,25,000 is 1 lakh. Pre-incorporation sale. This is pre-incorporation profit. This is post-incorporation profit. So this is the income. Now we'll go to expenditure. First expenditure. What is the first expenditure? Salaries. Salaries 24,000. Time ratio what's your time ratio? 1:3. Pre-incorporation 1/4 of 24,000, that is 6,000. Post incorporation 3 by 4 of 24,000, 18,000, 6,000, 8,000 goes to salary. What's the next one? These are rent and taxes. Rent and taxes, $9,600. 1 by 4 of 9,600. 4 2s are 8. 4 4s are 2,400. Post 3 by 4 of 9,600. 9,600 into 3 divided by 4. 9,600 into 3 divided by 4. 7,200. Rent and taxes over. What next? Office expenses. Office expenses. 4,000 into 1 by 4. 1,000. 4,000 post income. 3 by 4. 3,000. So 1,000, 3,000. Office expense over. Electricity charges 2,000. Electricity 2,000 into 1 by 4. 500. 2,000 into 3 by 4. So 4,000, 1 by 4 is 1,000, 4,000, 3 by 4 is 3,000, 2,000, 1 by 4 is 500, 3 by 4 is 1,500. So electricity over. Then insurance. Insurance 1,600. Pre-income 1 by 4. 400. Most income 1,600 into 3 by 4. 1,200. Electricity over. Then director fees. Post incorporation. We have auditor fees. Auditor fees. Auditor fees 2,400 into 1 by 4. 1,600. 2,400 into 3 by 4. 2,400 into 1 by 4 is 600. 2,000 into 1,800. So direct auditor fees is over. Interest on loan. Interest on loan. Interest on loans 1,200 into 1 by 4. 300. 1,200 into 3 by 4. 900. What is next one? Interest on advertisement on sales ratio. Advertisement on sales ratio. What's your sales ratio? 1:4. What's your advertisement? Advertisement is 1,000. Pre 1,000 into 1 by 4. This is 1 by 5. 1:4. 200. Post 1,000 into 4 by 5, 800. 1 by 5, 200, 800. Advertisement based on sales ratio. 1 by. Now, advertisement over. Commission on sales, sales ratio. Commission on sales, sales ratio. What's your commission on sales? 2000 into 1 by 5, 400. Post 2000 into 4 by 5, 1600. Then commission on sale is over. Then bank charges, time ratio, What is your bank charges? 400 into 1 by 4, 100 rupees. Post 400 into 3 by 4, 300. 1:3 ratio. Now, what is next one? Carriage outwards. What's the amount? 1250 on sales ratio. 1:4. Pre 1250 into 1 by 5, 250. Post 1250 into 4 by 5 is 1000. So back dates on sales. What's a back date? 750. Pre 750 into 1 by 5. 5 ones are 5. 2 remaining 5. 150 balance. Post 750 into 4 by 5. 600. Now, pre-incorporation over. So back date, preliminary expenses charged to post. Last one, depreciation. Time ratio. 1:3. What's the amount? 2800. Pre division. 1 by 4 into 2800. So 2800 into 1 divided by 4 is 700. Post 3 by 4 into 2800, 2100. So we have divided everything. Then this bad primary expense will come on post incorporation. Here salary time ratio, rent and tax time ratio, office expense time ratio, electricity time ratio, insurance time ratio, sales based on sales, director's fees post incorporation, auditor fees, interest on loan. I will explain this auditor fees. If the auditor fees is, there are three ratios you have got the same. If it is on tax, if it is on company, if it is internal audit, there are three types auditor fees. One is for internal audit, one for tax audit, one is called company audit. If they mention internal audit, it is time ratio. If they ask tax audit, then it's a sales ratio. Then company audit is post incorporation. So auditor fees, internal audit, time ratio, tax audit, sales ratio, company audit problem. Here, auditor fees is not mentioned. Has come back. Auditor fees is not mentioned. So, as a student, you consider as a internal audit. Go with the time ratio. Go with the time ratio. Then director fees after the incorporation is over. Once incorporation is take place, then only will appointed the director of the company. That's why it will come post incorporation period. Preliminary expenses will come on post incorporation period. So you put it format now. Come back. Basis sales 1,25,000. Basis sales ratio. Basis sales. What's your sales ratio? Come back here. Your sales 1:4. Already divided. Pre-incorporation profit is 25,000. Post-incorporation is 1 lakh. We'll underline this. You consider this as A. Come back. 1 by 1. Divide. All these are expenses. This is revenue. Sales 1:4, 25,000, 1 lakh. Now, expenses, salary. See, is 24,000 based on time ratio. Type 1:3. You have divided. First one. Salary 6,000, 18,000, 6,000, 18,000. Then you have got rent and taxes. Rent and taxes 2,400, 7,200. Rent and taxes, time ratio 1:3. It is 2,400, 7,200. Then rent and taxes, office expenses, time ratio 1:3, 4,000. 1 by 4 of 4,000 is 1,000, 3,000. Then electricity, time ratio 1:3, 2,000 is there, 500, it is 500, 1,500. Then insurance 1,600, time ratio 1:3. This is 1 by 4 means 400, 1,200. They are in the ratio 1:3. Director fees, basis, post, director fees. What's the total director? 3,500. Directly connected. No base. Auditor fees, time ratio 1:3. 2,400, 600, 1,800. Then Interest on loan time ratio 1:3, 1200, 300, 900. Then advertisement on basis sales ratio 1:4, 1/5 means 200, 800. Then commission on sales ratio 1:4, 2000, 1/4 means 400, 1600. Then bank charges 400, time ratio 1:3, 400, 300. So based I have given ratio, sales ratio, time ratio 1 lakh. This is only a revenue. Others are expenses are there. Come back. Carriage outward sales ratio, basis sales. This is 1:4, 1250, 1/5, 250, 1000. Then bad debt on sales ratio 1:4, 750 into 1 divided by 5, 150, 600. Then delivery expenses here, post 1500, post incorporation, depreciation, time ratio 1:3, 700, 2100. So based on this, now you have to add the pre-incorporation expenses and post-incorporation expenses. All the expenses should be added. We'll go with the revenue. This is only a revenue. All our expenses, you got 6,000 plus 2,400 plus 1,000 plus 500 plus 400 plus 600 plus 300 plus 200 plus 400 plus 100 plus 250 plus 150 plus 700 is equal to 13,000. Total expenses pre-incorporation period 13,000. Come back to post-incorporation. 18,000 plus 7,200 plus 3,000 plus 1,500 plus 1,200 plus 3,500 plus 1,800 plus 900 plus 800 plus 1,600 plus 300 plus 1,000 plus 600 plus 1500 plus 2100, 45,000. You call this as B. So 13,000 pre-incorporation expenses, 45,000 post-incorporation expenses. What's your total revenue? 25,000. So capital profit here it 25,000 minus 13,000. So it works out 12,000. Then revenue profit here 1 lakh minus 45,000. It will come 55,000. So your expenditure, you call this as B. Capital profit A minus B. Revenue, your revenue is how much? 25,000. You call this as A. You call this as B. A minus B. 25 minus is 12,000. This is capital profit. This is revenue profit. This is, add this. This is 25,000. This is 1 lakh. Right here. Note. Capital profit is transferred to capital reserve. Revenue profit transferred to profit and loss account for the distribution of dividend to shareholders. Capital profit should not be utilized for distribution of dividend. Revenue profit can be utilized for distribution of dividend to shareholder. If there is a capital loss, it will go to goodwill. Remember, capital profit is transferred to capital reserve. If there is a capital loss, it will go to goodwill. So revenue profit will be transferred to profit and loss account. If there is a profit, that will be distributed. If there is a loss, no distribution is there. So you have to remember now what I did now. So sales is revenue. Sales in ratio 1:4. I divided 25,000, 1 lakh as a revenue. Then all expense have been divided in the ratio. Have taken the basis ratio 1:4. I have divided. Here, see that. Come back here. Incorporation period I have explained. From 1/4/2019 to 1/7/2019. That is pre-incorporation period. Then from 1/7/2019 to 31/2020, that is 9 months, post-incorporation period. Therefore, time ratio 3:9, 1:3. Sales ratio, pre-incorporation is sales 1 lakh, post-incorporation is 4 lakh. Sales ratio 1:4. Working out gross profit based on sales ratio. This is gross profit, 1 lakh sales ratio. So pre-incorporation 1/5 of 1,25,000, 25,000 post-incorporation 4/1 lakh. No. that has been put it here. Then all expenses are divided in the time ratio, pre-incorporation, post-incorporation, and put into format. The format, this is your total expenses of pre-incorporation, post, and out of the sale deducted. This is your capital profit. This is your revenue profit. So capital profit will be transferred to capital reserve. Revenue profit will go to profit and loss account. Hope you understand. I calculated detailedly with working note which are the capital profit, which are the revenue profit, pre-acquisition profit, and post-acquisition profit. And here, whatever the pre-acquisition profit comes, capital profit transferred to capital reserve. Whatever the profit comes and the post-acquisition or post-incorporation is called revenue profit. Revenue profit will transfer to profit and loss account. Hope you understand. We'll meet in the next session with another good problem. Till then, goodbye. It is your BSS of Department of Commerce reporting you. We'll come back with another session with another good one. Till then, goodbye. Meet you in the next session.